Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra, with me is Sonal, and today we have our guest who's come down to the studios. We have Chintan Haria with us, and this is our first conversation.
Thank you.
So thank you for coming to our studios. Today we're actually going to talk about a very interesting topic, right, which is the smart beta strategy. Now this combines active and passive, and this category has really grown. There are now, over 40 schemes which are available. Sonal, so it'll be very interesting to, understand how this actually works, who it's well suited to, and how do you pick from this wide array of schemes?
And what kind of returns can one generate from this category as well? So, Chintan, thank you so much for joining us.
My pleasure.
Exactly the first question, as Pavitra was mentioning, a very interesting strategy that combines both passive and the active side. Can you explain to us how does it work? For somebody who's looking to invest, they would like to know the basics.
Sure. So, most people call it active and passive. So, if you look at active funds, essentially a mutual fund manager based on a universe of stocks, based on their style, would create a portfolio of 30-40 stocks. And because it's an active fund, it can be churned based on the change which the mutual fund manager wants to make, the active fund. Passive funds generally in India, which are the larger ones, are the market cap oriented. So typical market cap oriented funds have a larger AUM around that, where you are basically picking the top 50 names, top 30 names. In the last 3-4 years, much like in the rest of the world, smart beta as a concept has picked up. And what is smart beta in essentially? It is a mix of both, like you mentioned. And how is it a mix of both? Much like how an active fund manager is selecting a universe, then based on a particular factor or multiple factors, creating a set of 30-40 stocks. In a smart beta also exactly that is done. What do I mean by that? In a smart beta ETF, for example, let's say low vol. You pick a universe of top 100 names, and you pick the 30 stocks which is lowest in terms of volatility. And then you rank them in terms of volatility. You can have weights which are also based on volatility. That's the true to label smart beta, where the weights and the selection of constituents is based on smart beta factor. It could be low vol or momentum, which are price based. And much like a active fund manager is normally fundamental based. So you'll find them having value as a bent or growth as a bent, right? So if interest rates are falling, typically value does well, or if interest rates are rising up, typically you will find that growth stocks can potentially have a downtick. So if you look at from an investor perspective, smart beta, you can choose whether you want value, growth, momentum, low vol, suitable for you as a portfolio mix.
Okay, that's very interesting. So it's kind of like having two layers, right? One part is identified in a passive manner, and then you can go and pick among that lot as well. Chintan, I was just wondering, are there certain market cycles that these tend to work better in? I know over a long term, which is, how it's suggested to invest, things average out.
Yes.
But still, the entry point does matter.
Yes, it does. And that's where it depends on which factor you're choosing. So if you look at 2015 to 2020, when interest rates were coming down, high quality was doing well, and they were being priced at higher PEs. So quality as a factor tilt even in passive was doing well. If you look at the last 3 years, it's essentially momentum and value which is doing well, because value, after almost 10 years of underperformance between 2010 to 2020, suddenly saw the turn happening, and last 3 years value has done well. So actually it's something which smart HNIs or the people who understand markets well are able to pick. And so which factor you choose will determine where you make money and how you generate alpha from the smart beta. But yes, different market cycles and different macros would mean different factors do well. If you can marry the two and pick the right one, you generate alpha in the smart beta factors as well.
That's exactly what one would want, right? To
Yes.
marry most of the factors to ensure higher returns. And there's been a lot of interest. The number of smart beta funds, they've increased substantially. In 2016, we had just 4. In 2020, there were 9. In 2021, we had 16. And now we have over 40. So there's been a big increase, right? Why have these funds become so popular? What's so interesting about them?
So it's in line with what's happening in the globe. If you look at even the globe, out of the close to $10 trillion of assets that are there total, and $7 trillion of equity assets globally in ETFs, about $1.4 trillion or 20% is in strategy based. The 3 most popular strategies globally is dividend yield, growth and value. In India, of course, dividend yield won't work, because in India, the dividend yields are much lower than interest rates, and India is a high growth country. So in the Indian context also, we've seen more players launch ETFs in general, or financial products, or financialization in India itself has grown, right? Because our savings is growing, and a large part of younger Indians are choosing to go the financial way rather than going the physical way in terms of investing either in gold or real estate. So to capture that piece, many AMCs, including ours, have a wide range of products, even on the ETF side, the active side, alternate side, to cater to them. And as part of that, you're seeing the growth in India as well. In India, the two popular strategies are low vol and momentum, both in terms of AUM and in terms of recall from an investor standpoint. And not surprising, because if you look at the last 3 years, momentum has done well. And prior to that, low vol was doing well. So it's just two which have basically caught AUM. But there are others as well, which I'm sure as we move along will get investor attention and capture a market share from a smart beta perspective.
And I think as this entire passive piece is just picking up, I mean, I think we're still at a very young stage in India, right, where passives are concerned. So this is perhaps going to pick up in line with that as well.
We are at a young stage, I think, in everything. I mean, the youngest country, the youngest working population, and we are going to be young for the next 20 years. So
the asset depth is way higher in a market like US. So of course, it's understandable.
But that also means that the growth is going to come here in a big way, which is, you know, of course, what everyone's been talking about. Chintan, who do you think this kind of strategy is well suited to? And, you know, since you're essentially, in a way, picking a kind of investment, do you think this is meant for a more sophisticated, experienced investor? Or do you think because there are so many funds, there's something for everyone?
Yes, there is something for everyone. And as we generally say that when an investor is creating a portfolio, you have an approach wherein 50% of your portfolio you have in asset allocation funds like the Balance Advantage Fund category, multi-asset category. Then you have certain allocation to gold, of course, and the balance 20-25% you can have in active diversified funds. The rest 20%, based on your risk appetite, you can allocate towards smart beta or passive products in general, because the debate always says active versus passive. I say active and passive both have a place in an investor's portfolio. Within passive, if you are a new investor, you should start with market cap based because your understanding is low. And as you develop your understanding of factors, which is not easy, you need to have understanding of what are the price based factors, what are the valuations, fundamentals, how many investors actually even read an annual report. So to understand the ROCs, ROEs and price to earnings, price to book is a matter which requires effort. So once you put in that effort to understand the factors, you can surely choose the smart beta products as well, or have an advisor to advise you. I think that's the easiest, because you cannot know everything of everything, but an advisor can definitely help you. And to that extent, different smart beta products can work for different types of individuals. So if I'm conservative, maybe a low volatility product will work for me, because there you are taking stocks which are stable. Low vol by definition are stocks which are stable relative to market, and so their risk adjusted returns are better. If I am wanting to increase the risk in my portfolio and the return profile, then maybe momentum is something which I would choose. If I want to move from growth to value, I'll choose a value, because in my portfolio in general, because last 6-7 years, if only growth has done well, by definition, investors would end up having a lot of growth in their portfolio, growth-oriented stocks and mutual funds. To diversify, they can simply pick up a value-based smart beta product, because in a passive fund, it is always methodology based, and you get what you see in terms of the methodology. So there is no active involvement to the extent that I can change the style. The style is what you would get, and hence that comfort you get that if I'm investing in a value based on the universe, the fund will keep moving. And also one part which is making passive smart beta products active is every 6 months, there is a rebalance happens, which basically based on the universe, you again calculate the factors, and the index provider would ask you to rebalance the portfolio with the latest available data. So that gives an element of active involvement also in passive funds. So I think it is a good mix for investors in the long run, and you need to know what suits you well or which factors would do well. Not easy, but I'm sure with, let's say, experience, it can be known to investors where to put your money right now.
So in that case, when they are deciding to put in money somewhere, is there a minimum time period that they should have in their mind? Is it only for long-term investors, or what duration does it work for?
So generally, equity investment should be ad infinitum. You basically keep it forever. But I understand that neither in Western world nor in India that happens. But at least 5 years you should have, in terms of giving the style the chance to grow. Because if you look at value, for example, right, you could have felt value would do well in 2017, 18, 19. It finally did well in 21, 22. So if you have time in your hand, it works better for you. And with that, in keeping that in mind, at least 3 years, if not 5. And when you choose and how you, the let's say size your bets also matters. So you always keep some powder dry, that if it goes against you, the factor goes against you for a time period, because cheap can become cheaper in our markets. We have all seen that. PSUs was a classic sector, right? We thought 2017 it was cheap, 2019 it became cheaper, and 2021 it was the cheapest in last 20 years that it saw. And then next 2 years, be it PSU banks or PSU sector, that was the best performing sector. So you need to size and layer your investments in a way that you average on the way down and then wait for it to unfold. So I think patience and 3 to 5 year time horizon should do well for investors looking to invest in equities in general and smart beta in particular.
Okay, got that. 3 to 5 years. That's a very reasonable time horizon to hold, right? I mean, I think forever is asking for a bit much.
Yes.
But Chintan, take us through what the performances look like. You were also mentioning that maybe when you're getting in, get in with a regular passive fund based on market cap. What does a smart beta fund look like versus just a plain index fund? I want to see if there's always a good outperformance.
So like I said, different factors will have different time periods in which they will perform. There was a time period between, let's say, 2020 and 2022. Momentum did very well, caught the imagination of investors. Prior to that, when markets were going nowhere between 2018 to 2020, low vol was doing well relative to markets. So it depends on the start period and end period. Like you had mentioned earlier, over a period of 5, 10, 15 years, it averages out. But if you can pick the right spots, like value, for example, between 2021 and 2023 has done better than growth. And growth prior to that between 2018 and 2021 had done well. So from a performance standpoint, if you have to compare, it depends on the starting point. And to that, what investors generally do is follow what's done well and invest there, which probably is not the right thing to do. You end up hurting yourself a lot more when you invest in something which has done exceedingly well in the recent past. So again, it requires a little bit of understanding that when something has done badly, you try to invest there. When something has done too well, you try to book some profits and reshuffle your portfolio. So it's part of actively allocating your assets between value, growth, tilts. And I think in the long run, if you're able to do that, it will be a value creator or an alpha generator in your overall portfolio mix.
Okay, all right. So, you know, to make that, those factors marry each other, make it understand to do the viewers as well. That's why we have experts like you in the studio as well. It's a very interesting chat, but we have to get into a quick commercial break. We'll continue this chat on the other side to understand everything about smart beta investing with Chintan Haria. Welcome back. You're still tuned into MF Corner. We still have with us Chintan Haria, and we are discussing everything about smart beta investing. When Chintan, we have spoken about a lot of factors which could lead to higher returns here and what this particular category is really like. But how can investors determine which smart beta strategy is suitable for their investment goals and returns that they expect as well here?
So when an investor is creating their own basket of products, like I mentioned, they'll have a variety of products which hopefully give them enough diversification, because more often than not what we end up seeing is that if a particular segment has done well, let's say in the current instant mid and small cap has done well, the natural tendency would be to invest more and more in that, and you become over invested in that segment. To avoid that tendency, probably investors, when they are creating their portfolio, should see what is counterbalancing. So for incremental investments, what is counterbalancing their existing holding, which is not expensive and has the potential to give you returns. So there are many alternatives available, but in the case of smart beta, if we look at it, since most portfolios would have a diversified basket, if you want to basically reduce your risk, you go for the low volatility product to balance the risk, wherein you are taking stable companies, which in the last 3 years actually has not done well. So low vol as a product in terms of performance has probably not done well, because stable stocks versus value stocks have not done so well, and stable stocks were expensive 3 years back. So you choose in terms of diversification based on your existing portfolio, but you do keep in mind that you're not tilting towards a particular segment, let's say between large, mid and small, or value versus growth, at a time where if value has done too well, you don't tilt your portfolio extensively towards value. So look at your portfolio in totality and then decide what fits in, because investments, much like a cricket match, will require different set of players in different conditions. So it is something which needs advice, to be honest. And so in India, most investors try to do their own or do it themselves, which sometimes is counterproductive, or most times does not lead to alpha generation. So have an advisor, it will be useful, I would say, and have a good team of 11 funds.
You just touched the wrong nerve right now. We have Rohit Sharma who's been bowled out, so I think...
You don't need bad news in the middle of our show right now. But, we were discussing some of the risks associated with this. Tell us, how do you mitigate these risks? And because you're getting into, pockets like this, is it a good idea within smart beta to diversify also, just to sort of create that balance?
Yes, so mitigation of risk at a portfolio level is very important, and there the diversification would matter. Generally, if you look at in active funds, the fund manager does the job of, let's say, changing the portfolio based on the market dynamics, depending on whatever the SID allows the fund manager to do. But in the case of passive, since you are normally self-selecting the products, even within smart beta, you can have a diversification in a manner that if you feel a certain portion should be in value, a certain portion should be in momentum. The risk is, of course, and I again repeat, this is probably the third time I'm repeating, but it's very important, that if something has done well and you load your portfolio in that favor, it's something which you should be careful of, because contrarian thinking, contrarian investing is very difficult to do. That's why very few successful investors are able to do that. But investors should try to imbibe that fact that you diversify your risk by having, let's say, certain elements of small cap, mid cap, but not fully in small cap, mid cap, certain elements of momentum. But to counterbalance all of these, you should have value and low vol in your portfolio. So a good mix should be there, but how much, what proportion would depend on the market dynamics. Today, if I look at the market, since value has done well in the last 2 years and growth has underperformed, maybe those investors who are lucky and had invested in value 2 years back should try and probably swing a little bit towards growth and value, towards growth and quality, maybe over a period of next 12 to 24 months, because that space is now looking more and more attractive, though not cheap, but more and more attractive. So investors can diversify their risk by simply moving between these factors.
Okay, all right. So in that case, which are the smart beta funds you would recommend to the investors, considering the market setup that we are in right now?
So I think market is currently in a scenario wherein high interest rates are making global scenario a little difficult, but India seems to be in a sweet spot. Yesterday the GST numbers were also quite good. I think more than 1.7 lakh crores, second highest ever. So, or second time it's crossed 1.7 lakh crores. So in that context, it is better to be in large cap. It is better to have a portfolio which is in low volatility product. So I think low vol is something which investors should have in their portfolio as a base or as a foundation. And then on top of low vol, if investors want to build a little bit of momentum in their portfolio, they can have momentum in a particular percentage. I would say 80% of your incremental money in low vol, 20% in momentum, build it over a period of time. That should serve well over the next 3 to 4 years, because you're getting a little bit of, and if you want both together also, there's a product called as alpha low vol, which is the first multi-factor smart beta product in India. You can invest there over a period of next 12 months. I think you'll need to stagger your investments, because next few months are uncertain given what's happening in the globe.
All right, that is very helpful advice. And Chintan, thanks for taking us through a complete class on how you go about smart beta investing, what could work, what are the risks. So I think this will be enlightening for all of our viewers.
Exactly, and especially considering, as you were discussing as well, right? It's not something that's easily understandable and not very straightforward. Yeah. So always good to get some advice. Thank you so much for joining us today. And with that, we will do one thing. We'll take your leave on this edition of Mutual Fund Corner, but you stay tuned for Closing Bell to take you through the last hour of trade. Thanks a lot for tuning in.